After 2 years of strong equity returns, market sentiment shifted abruptly from euphoria over AI productivity gains to growth concerns from President Trump's policy agenda. Technology and small-cap stocks have seen the most severe declines this year, contributing to a 10% decline in the S&P 500 since the start of the year. International companies have held up much better, with developed international stocks up nearly 5%. Growth-oriented sectors such as consumer discretionary, information technology, and communication services have led the market lower. The only sectors in positive territory this year are the defensively oriented consumer staples and utilities. The downturn in the market has pulled the forward price-to-earnings ratio of the S&P 500 down to 19 times from over 22 times at the end of last year. This is still above the 30-year average of 16.9, indicating that though U.S. markets are cheaper, they may still be overvalued. The Magnificent Seven companies, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, have seen a significant pullback this year. These are all multinational, growth-oriented companies that are particularly impacted by high tariffs. If the trade war pushes the U.S. into a recession, these companies will face growth headwinds as well. In economics, there's a concept of hard data and soft data. Hard data, such as inflation, is measurable. By measuring the cost of a basket of goods and services, we can see how quickly prices are increasing or decreasing. After hitting a peak of 9% in 2022, the Consumer Price Index, or CPI, has come down to 2.4%. Core CPI, which strips out food and energy, remains slightly higher at 2.8%. The Federal Reserve would like to see inflation closer to 2%. On the other hand, soft data is that which is considered to be qualitative and subjective. For example, inflation expectations are collected by surveys, asking people where they think inflation will be in 1 year or 5 to 10 years. Coming into 2025, both 1 year and 5 to 10 year inflation expectations were about 3%. The Trump administration's Liberation Day tariff announcement have helped push 1 year inflation expectations to 6.7% and 5 to 10 year inflation expectations to 4.4%. Hard data on the labor market includes the number of jobs in the U.S., measured by non-farm payrolls and the unemployment rate. Recent non-farm payroll numbers show a strong, though softening, labor market, while unemployment at 4.2% is historically low. The year-over-year change in non-farm payrolls shows an interesting pattern. When this number decelerates below 1%, it typically coincides with the start of a recession, shown here in gray bars. This figure currently sits at 1.19%. We watch this data point with particular interest for hints that a recession may be looming. Consumer sentiment is another soft data point taken by survey. The recent consumer sentiment reading of 50.8 is the second lowest on record, even lower than in April 2020 during the pandemic. Consumers are concerned that tariffs will raise already high prices of goods, causing growth to slow and resulting in a recession. The federal funds rate hit a peak of 5.5% in 2022 and was cut by 1% last year. There are expectations for another 0.5% to 1% of rate cuts this year, but all of this will depend on what happens with inflation and the labor market. If tariffs do increase prices, the Fed will be less likely to cut interest rates. However, if the labor market shows signs of weakness, they may need to act. Given the continued uncertainty around tariffs, we are more focused on economic data. Although soft data indicates that a recession is imminent, the hard data does not tell the same story.